This is a fun section because if you catch a great trending move, you can scale in and add to your winning positions and really maximize your profit. And that's what I'm going to teach you here in this lesson. First, let's go over the rules to adding to winning positions. The first rule is to have predetermined entry levels for additional units. The second rule is to calculate for risk with the additional units being added. And the third rule is to use a trailing stop in order to grow your positions with less risk. Let's just dive straight into an example so you can see clearly how this works. In this example, you're watching the Euro USD, and after a bit of consolidation right here, you think the pair is going to climb even higher. So you place a buy order right here at the 1.1900 price level. You decide a good place to put your stop loss would be here below this minor support right here at the 1.1800 price level. And then you have your eyes set up here on a major resistance level where you think you will take your profit at the 1.2200 price level. So right here, your stop loss is 100 pips away from your entry point, and your take profit is 300 pips away, which gives you a 1-to-3 risk to reward ratio, which is great. Now, let's say you are feeling very confident on this trade, so you are willing to risk more than 2.5%. You decide that you will enter here with a starting risk of 1%, and that every 100 pips that the market moves in your favor, you will take another trade and trail your stop by 100 pips. For even numbers, let's say that you have $10,000 in your account. So for your risk of 1% or $100, with your stop loss 100 pips away, you would enter with a 0.1 lot size. I always use our calculator to find this, so don't worry if you're confused on how to calculate that. You can use the calculator, and it's really simple. Let's go through and see what the risk to reward would look like by adding another 10,000 units or 0.1 lot size every 100 pips and trailing our stop loss on all trades by 100 pips. Before moving on, I just want to point out this table. You can see our first trade we took with 10,000 units at the 1.1900 price level. And you can see right here that we would have a max profit of $300 up here. And the max loss that we could have would be $100 if the market moved down here and hit our stop loss. So here's the 3-to-1 ratio that you can see there. So now you can see that the market's moved up another 100 pips to the 1.2000 price level. So what are we going to do? We're going to place another trade right here, another buy trade with a 0.1 lot size. We then are going to move our stop loss right here to the 1.1900 price level on this new trade, and also move our old stop loss up to that same point because we're always going to trail by 100 pips where the market is. So now we're in two trades, one that started down here at a 0.1 lot size and one that started right here at a 0.1 lot size. And we have the stop loss on both of these trades right here. So on the first trade at 10,000 units, like we talked about, now the max profit is still $300, right? Because we're $100 in floating profit actually. And with the new stop loss right here, where we started at 1.1900, the most we could lose on that first trade is $0, is just break even. And then at this second trade that we took, we traded with a 0.1 lot size or 10,000 units at 1.2000, which would mean that the max profit we could take would be 200 pips up here, and that would be $200. And with the new stop loss right here, 100 pips away, the most we could lose on this trade would be $100. So the new total risk to reward ratio is 1-to-5, so it's getting even better. Let's go ahead and move on now. Okay, you can see that the market moved up here another 100 pips to the 1.2100 price level. So now you can see that our very first trade that we took all the way down here is currently 200 pips in profit or $200 in profit and floating profit. The stop loss has moved up again to here. So now actually on this first trade, our max profit that we could make is $300 if the market reaches here. And the most we could lose would be, we would make $100. So actually now at this point, we've secured profits on that first trade that we entered down here. Then on the second trade that we entered at this point, you can see that we're at the break-even point because if the market moves back down, we would just break even at the stop loss, and the max profit is still at $200. And that trade is actually in $100 floating profit, the one that we entered right here. Then this third trade that we just entered into right here has a max profit of 100 pips or $100 in this case, and the most it could lose would be $100 because the stop loss is 100 pips away. So now if you look at our total risk to reward ratio, you can see that the most we could lose total would be $0, so break even, but the most we could make would be $600 if the market reaches up here. And we're currently in $300 of floating profit. So you can see that if the market had kept moving up to our max profit target, we would have profited $600. And it was cool because we slowly scaled into this trade. Remember, we started with just one trade down here. The max we could have made was $300. And by the end, we made $600. And as we scaled into this trade as well, the risk got less and less because we were moving our stop loss up. We were trailing our stop. And the early trades were going into more profit, which made the new trades even less risky. So there you have it. If this didn't make a lot of sense, maybe go back and watch this section one more time to better grasp this. But this is a pretty simplified example that shows the basic technique of how to safely add to winning positions and how effective it can be to maximizing your profits. Now, before you go adding to every winning position you have, be aware that this is really only effective in trending markets or strong moves during the day. So you can see this market, for example, was obviously trending up and was making strong moves up, which was a good opportunity to add to our winning positions. Scaling into winning positions in range-bound markets, for example, right here when it was ranging, is not a good idea because this is often a period of low liquidity and a lot of times you'll get stopped out. The last thing I want to mention is for you to be careful with how much margin you are using. By adding to winning positions, you use up your margin and you may miss out on other great opportunities if you don't have any free margin to trade with. So definitely give this a go, but first on a demo account until you feel very confident with it that you can scale in and add to your winning positions and make more on your trades.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.